Hello, chart watchers, and welcome to this Wednesday, April 11th Market Watchers live show with your hosts, Tom Bowley and Erin Swenlin. For those of you joining us for the first time today, welcome to the show. You picked a good one. And for our regulars, welcome back. Well, the market is trying to rebound off some earlier lows. The Dow Jones Industrial Average still down 100 points. The S&P 500 moving closer to its break-even point, down 2 points. The NASDAQ, however, has moved into positive territory, up 14, and the Russell 2000 also showing relative strength, performing better than any of the major indices currently, up 6 points, about 0.4%. 10-year Treasury yield did fall earlier today, but it is well off of its lows, currently down to the 2.78% area. The volatility index continuing to drift a bit lower. This is good news for the bulls. High volatility tends to lead to panic selling, and we have seen the VIX moving lower here over the past couple of weeks. The XLE continues to move higher. We'll talk about crude oil in a bit, but crude oil is breaking out, and that is leading a lot of folks into the energy space. The oil equipment and services index making a big breakout here. This led the energy space yesterday. It's leading again today and making some new highs. The best performer in that industry is Neighbors, NBR. You can see a very strong day here for Neighbors, challenging the high that was seen a few weeks ago in March. The worst performer on the Dow is Dow DuPont, down about 1.3% today. One of the top performers in the S&P 500, also in that energy space, National Oil Well, breaking out above recent highs and some congestion around $38, having a very nice day today. And also one of the best performers in the S&P 500 and the best performer in the NASDAQ 100 today is Netflix. Their target was raised by Cowen & Company from 275 to 325 ahead of their Monday earnings. And we do have a poll today that you can fill out what you think Netflix may do after they report earnings on Monday. And with that, let me bring in my co-host, Erin. How are you doing this morning, Erin?
I'm doing quite well. Thank you very much, Tom. How are you?
I am doing great. This is a very special day because we have your dad here, Carl. How are you doing, Carl?
Really great. Thanks.
That's awesome. And this is also a big day. Now, do the Ducks play today, Erin? Do they play?
Oh, no, that's tomorrow night. I'm getting a little nervous, but we're really on a roll. So I think we're gonna be able to do it at home.
And do you have the Sharks in the first round? Who do you play?
Right. Yeah, we're playing the San Jose Sharks. And just a sort of side note for fun, if you go to NHL.com, I did open up a bracket challenge with the league name Stock Charts TV. If anybody out there, I know most people are like, hockey? No. But if you're interested, you don't have to know anything about it. You can go and fill out a bracket and see how you do.
I know on the other side of the bracket, I mean, I can give everybody some great hockey tips here. The Capitals usually do win their first round. I'm a big fan, been following them for many years. They'll get through the first round. I think they play Columbia. Sorry if there are any Columbia fans out there, or Columbus, I should say.
Yeah.
But then in the second round, the Capitals are slated to play the Penguins. And yeah, if they beat the Flyers. And of course they will, because they just love playing the Capitals in the playoffs because we're a bye. We're literally like a bye for them. It'll be a 7-game series, but they'll win, probably blow us out in game 7, and it'll be another disappointing offseason for us. I've got it all already.
Optimistic. You should be more optimistic.
No.
Ducks are going all the way. Positive.
No, I'm not thinking positive. Not until they give me something to think positive about. This has been the worst playoff team in history, I think.
Yeah.
They do great during the regular season, get into the playoffs, and then can't do anything. But anyway, let's get going. I know we got
you guys, hey, the crackling sound you hear, that's my eyes glazing over.
Are you not a hockey fan?
I'm not a sports fan.
Oh, yeah, I did that all on my own.
Yeah, where'd you get this from, Erin?
I don't know. My mom actually watches a lot of sports, or she did.
Okay.
Yeah, she taught me football.
Okay.
Yeah.
All right. I just made some assumptions here I shouldn't have made, I guess.
Yeah.
You go ahead and get started with the schedule on the agenda.
No problem. So really what we've got coming up, really on Friday, the only thing we have coming is my workshop. I'm going to do it on divergences and confirmations. Probably throw a little bit of, a little bit of convergence in there as well, but mainly divergences and confirmations. That's what we're looking for. Today, of course, after our technical headlines, my dad Carl will be coming in. He's got some great charts, 10 and 10 to 1. Our first symbol is going to be GEO. And I have to give props to the guy who tweeted just me last night and said, "Hi, Erin. Hey, can I get this symbol in?" I was like, wow, he knows who the gatekeeper is for sure. So he gets his first shot. Sector rotation will finish off the program. And with that, Tom, I'm going to hand it back to you for the technical headlines and news.
All right, sounds good. Appreciate it. And we'll be getting back to Carl in just a few minutes, maybe 10 minutes or so. I do want to say we had a couple of economic reports out. Again, inflationary data out today. Yesterday we had producer price index. Today it's consumer price index. The March CPI came in at negative 0.1%. Market was expecting a flat number. And core CPI for March hit expectations with a rise of 0.2%. So no big surprises for the market. We did see initially a move to the downside earlier in the 10-year Treasury yield as money was rotating into the bond market, but we have seen that begin to reverse again, and we are near the high of the day now on the 10-year Treasury at 2.78%. We'll see how that continues to move throughout the day. But in the meantime, let's take a look at crude oil. I'm going to pull up the WTIC, which is light crude. Now, keep in mind, this was yesterday's action. This is not today's action. And you can see that we have a top between about 66 and 66 and a half that we have been trying to negotiate for the past couple of months. Also, before I get into where we stand right now with crude oil, let me pull up a longer term chart, because what we have is a nice uptrend, equal highs, rising lows. We've got a bullish ascending triangle in play. And I'm going to give you the latest here on crude oil. Let me get it up to the minute. 66.90. It was just over $67. 66.90. It's up over 2% today. So if we go back to that daily chart, we are currently at a breakout level on crude oil. And so the big move we saw yesterday on crude oil, and of course, if I let me go ahead and annotate this with that XLE in here. I did this yesterday, and I think it's really worthwhile to do it again. But if you pull up the price and type in XLE, and instead of putting it in an indicator window below, I'm going to put it behind the price, and I'm going to highlight it in pink just so it really stands out for everybody. And let's see what this looks like. But you're going to see the XLE has been underperforming. Now, without going into details and showing a long-term correlation chart, the light crude oil price and the XLE tend to go hand in hand throughout many, many years. So this is normally we see very strong positive correlation between the two. But look what happened here in the second week of February. After a drop in crude oil prices and a bigger drop in the XLE, you can see that we did recover quite a bit. We actually went all the way back up to the January highs on light crude oil. Testing or maybe putting in that double top, but it is in a nice uptrend here. And if you look down at the XLE never really rebounded. So we're just getting this breakout, and I think there's room to the upside where the XLE can play some catch up here. We're seeing it now, and if crude oil breaks out of a bullish pattern and starts to break out, I think that could really be a surge for the XLE. We could expect a surge to play even more catch up down the road. So I thought that was a very interesting development today. Now, of course, we want to see how crude oil trades throughout the day. Right now, we're getting a breakout, but if it turns around and we fail, then we may simply fall back into this consolidation. But even with that, I would look for the XLE to continue to perform pretty well. And as Erin and I mentioned on the show yesterday, the scooter on the XLE is now in the third spot, trailing only technology and consumer discretionary in terms of the highest scooter rankings. So energy is definitely picking up steam, and I think this breakout is adding to it along with the strength in crude oil prices. Okay, let's take a look at Fastenal. This is a company that reported earnings. We're just now starting to scratch the surface of earnings reports. We got a big number of reports coming up on Friday. 4 big banks report. JP Morgan reports, I think Bank of America, PNC, and Wells Fargo. I think those are the 4 that report Friday morning before the bell. And that's really, in my opinion, going to be the kickoff to earnings season. Netflix, as I mentioned earlier, reports Monday after the close. A number of the really big companies will be reporting over the next week or two. Many of the Dow components, a number of the S&P 500 components as well. But Fastenal reported. This is a company that actually showed growth, and this is why I think it's so important to follow technicals instead of fundamentals. Fastenal reported year-over-year earnings growth of more than 30%. They matched expectations, 61 cents versus 61 cents expected. And their revenues came in just slightly, ever so slightly below expectations at $1.19 billion. And look how rudely the stock is being treated, down 7%. The market's already anticipated the growth that Fastenal reached. But what the market, I think, was looking for was maybe an upbeat guidance, maybe a beat on the bottom line. And when Fastenal did not report it, I think that was the reason why we saw this move to the downside. Now, if you take a look at the longer-term weekly chart on Fastenal, you can see that they're on the most recent high. You can see the PPO is actually lower. So you've got higher prices, lower momentum indicator. The PPO is lower, and so that's a sign of slowing momentum. So all of these positive tests of the rising 20-week moving average failed, and now we quickly go right below. What I would be looking for, we have hit price support coming across here just above 50 on Fastenal, but we haven't hit that 50-week moving average. I think we could see a 50-week test. We could see this PPO drop all the way back down, at least to the center line, given the negative divergence that was in play there. I mentioned Netflix. Let's take a look at Netflix, and I own Netflix, but I will not own it heading into that earnings report on Monday. I don't like to hold stocks into earnings. But Netflix, there are a couple of things that I would be looking for on this chart. Off of the uptrend here that ended back in the second week of March, I would be looking for some sort of continuation pattern. We could have a left shoulder, a bounce to the neckline, lower low to put in an inverse head. This could be a move back up to challenge the left side of the neckline. So maybe we get into the low 320s. But I am not going to take a chance as to what Netflix is going to deliver, because it's not only the results that Netflix has. I can tell you based on their, the movement that we've seen in Netflix this quarter, their relative outperformance, I would be shocked if Netflix doesn't blow out their earnings, both revenue and earnings, maybe subscribers. I think that's what this chart is telling us, is that there's a lot of accumulation that's been taking place, and I think they'll have a good report. But the question will be, is the report good enough to break out? They're probably going to have to beat top and bottom line. They'll probably have to beat on the subscribers. If they have any kind of misses, I think we could maybe drift back down into maybe an inverse right shoulder. Maybe we have sideways consolidation between 270 and 330 for a while. There are a lot of different things that could develop, and it would still remain in a bullish pattern. But short term, I think there are a lot of risks as we head into Netflix earnings report on Monday. Upgrades and downgrades. I'm going to give you the upgrades, and Erin is going to go over the downgrades with you in just a minute. First, let's take a look at SYNA. This is Synaptics. They were upgraded. They're getting a nice response here. I think overall we've got a nice trend, higher highs and higher lows. And in the middle, or we're currently trading in the middle of this range. So I'm still fine with Synaptics. I think this looks pretty good. I'm going to pull it up on my relative chart that I like to use. And you will see that we do still have to get back up and negotiate this 50 area. That was, by the way, very, very solid support before heavy volume gap down in August. Lost that support level. So 50, I think you can tell looking at this chart, is going to be a big deal for Synaptics. As we go down the list, this is in the computer hardware space, the DJUSCR, which has been performing pretty well. Synaptics relative to this index, though, has not been performing great and does need to try to clear some relative resistance here. Relative to the S&P 500, same thing. It's trying to make a relative breakout. So it's kind of on the verge. I think if we can get through that 50 level on Synaptics, that's going to make a big difference on the chart and in its performance as we move forward. Next is Mattel. And I think Mattel, first of all, I know has been a very, very weak performer, and I'll show this on that relative chart as well. But in the short term, we did hold on to the support that was established back at the end of October on very heavy volume. You can see that hollow candle. Many times that's a reversing candle and becomes very significant support, and it certainly has since that time. We haven't been able to negotiate that to the downside. The bears haven't been able to take the support level out, and we are starting to rally again. So on the surface, this looks like it's improving, looks like a pretty good chart, but I wouldn't touch it. And the reason being, again, if we go to the relative chart, you can see Mattel has been moving lower. The toys industry as a group has been moving mostly higher, although it has been weak here in, well, maybe for the last 4 or 5 weeks or so. But overall, this has been a pretty good group. Look at Mattel relative to the toys. It has been an awful performer. This is not one of the best stocks. In fact, it's one of the worst stocks in this space. If you look at it relative to the S&P, if you're trying to outperform the S&P in your trading, Mattel is probably not one of the stocks that's going to get it done for you. And toys, as I mentioned, has struggled recently, but overall, over the past several months, I would say that this is a group that's been performing with the S&P 500, with some periods of exceptions moving in both directions, but pretty flat, I think, overall going across here. So Mattel being one of the worst performers in the group with this upgrade, I don't know, I'm a little nervous. I would pass on it. And with that, I'm going to pass everything over to Erin and let her go through the downgrades with you.
All right, let's get that started. Always interesting to get the downgrades and look at the charts, because sometimes they're good. If you get the downgrade, sometimes that can be an opportunity. And I think today, and you were talking about it too, Tom, that there are possible opportunities here in these downgrades, because some of them, it doesn't seem to be posing any problem for these stocks. Obviously, today we've got 1.25% down on Floor and Decor Holdings, FND. I think it's interesting. I'll say why. It's in a nice rising trend channel. It did fail to break out, but that's okay. It's come back down, and now it's getting ready to hit some very strong support right here at about 52.50, near the tops we saw at the end of March. And so it's coming back, and if it can hold that very strong support level and start moving back up to the top of this rising trend channel, I think that would be obviously good. Problem, the PMO is very overbought, and it does look like it's decelerating. Makes sense because we're getting that drop right now in that declining, short-term declining trend. But I think you could make a case for a bull flag here if you wanted. I would just be a little bit careful, because when we do see the PMO get up here at the top, that can spell trouble, and we might see that support level not hold. But OBV looks good, the rising bottoms with the rising price bottoms at this point. And of course, whenever you have a scooter sitting in the hot zone for that long, you know that it's got a good track record in the intermediate to longer term. So in this one, I think it looks fairly good. I just don't like the fact that we have that PMO that is so overbought right now. On Fortinet, FTNT, we had a failed breakout yesterday. It did hold it, but we've come back down today, and we're now starting to stick really close up to where we had yesterday's close on this second breakout, I would call, or continuation of that breakout we got yesterday. PMO is turning up. Volume, OBV is moving up. We've got a scooter that's in the hot zone. I think at this point with the downgrade, maybe we might see it come back down and move back into this trading channel. But I like the fact we broke out twice. And obviously the market isn't that concerned about the downgrade, with the fact that it's still continuing to break out at this point. The third one, Valero Energy. And I thought this one looked quite good. And, it's in that energy space, which we were talking about. I mean, I think that it's looking pretty good. We've got a breakout right now over that January high. We have a PMO that just had a buy signal and is heading up very quickly, putting a lot of margin between it and the signal line, rising OBV. And look at how long this one has been in the hot zone as far as the scooter. So, when you have that kind of like I said, that track record, we're seeing the breakout. Obviously, on the downgrade, you've got a stock that's up 1.5% right now. Kind of wonder what it would have done if it had been upgraded at this point. So with that, I'm going to end our technical news and headlines, and I'd like to bring in my father, Carl. Of course, I say Dad. I don't usually call you Carl.
Welcome to the show.
Yes. Oh,
Hey,
yep, gotcha. All right, excellent. So there we go. So here's what we're we've got for you. And yes, my dad has been actively engaged. You've been doing market analysis since the early 80s. I know that. And it's been impressive. I've learned just about everything I know from my father. He's taught me well. I've just learned the stock charts and started working on CMT. So I've gotten, a little smattering of everything. But welcome back to the show. It wasn't even my birthday, and I was able to get you to come back.
Well, you're welcome. Should I take the screen now?
Yes, go right to it. And what are you going to be talking to us about today?
I've got actually a 3-part presentation, and I've got to get my browser up here, it looks like. There we go. I want to talk about parabolics at first, and then moving along to earnings and showing how to get a technical look at earnings, and then finally showing one of the stock charts tools that I think is really cool that relates to dividends. So let me begin with the parabolic presentation. The subtitle of this would be Parabolics That I Have Known and Loved. The parabolic it begins flat and it just swoops up until pretty much the price is going vertical. And I don't hear people talking about this very much, but you see them on a regular basis. And here we have gold, a monthly chart, and obviously now I've reported on this every week pretty near, but it's one of the things that happened here once it broke the parabolic. You worry about it really crashing. As it turned out, it moved sideways for a while, and which case I thought it might have been going into a high level consolidation, but then it finally did break down, and we ended up with a 50% or close to 50% decline from the highs. You'll find in the parabolics that there are usually smaller ones embedded within the swoop, and they're small compared to the big one, but at the time, in that time frame, they were quite impressive, I'm sure. Here is one that it corrected somewhat, but it basically moved sideways. And then from out of that, another vertical move, and another parabolic curve there. And that's when it corrected a pretty good amount, down about 35%. But this is something that I look for on a regular basis, and it's one of those things that I don't hear many people talking about, but they happen all the time. Here's a really latest one, Bitcoin, and that's kind of like the tulip mania of modern times. But again, you see some minor swoops going up, but the major one is it just goes vertical. When you see that, especially with something that has no more substance than a bag of feathers, you just need to watch out. And here we've corrected 65%. I don't see any reason why it's not going to go lower, but again, this is a pattern that just when you start seeing prices go vertical, just figure what is your exit.
Hey, Carl.
Yeah.
Have you found yourself in one of these parabolics before? I'm just curious, if you've been in one before, if you've been invested in something like this, how do you, what would be your suggestion to somebody who finds themselves in something like this as to a signal maybe to get out before you see all the down move like we've seen with Bitcoin?
I just don't know the answer to that. But when you're in it, you've got to, you've got to figure, cut off your greed and get out at a reasonable gain. It's funny you bring this up. I'll go back to the gold chart. I happen to have a substantial position at time, somewhere around here when it was going up. And at one point I had a 20% gain. And I managed to escape with a 5% gain. So
hey, that 5% looks pretty good though now after what happened.
But it just shows you how fast they can move, and you got to know you've got to be prepared to get out of the way, no matter what the story is at the time, and how great it's going to be, because it's always got a story. And I should say that mostly you don't see these parabolics with as much with indexes, but they're more frequently seen with stocks. Usually a stock with a story and no substance, and they go up, and they usually crash all the way down to the base because there was nothing there to begin with. You still see them obviously in market indexes. They're just they're not quite as volatile most of the time, but when you start seeing vertical, you want to get out. Here we have the 1920s and 30s, and the swoop up to the October 1929 high. I shouldn't say. I think that was actually August high, and but here before that, you had another vertical advance and high-level consolidation. Would have been a good time to get out in hindsight, but I'm just saying, when you see and they start moving to the side, if anybody that got out here was feeling pretty good about it down here. But again, this was one. The market lost 89% of its value.
Yeah, and that one was a long time ago, but I think one that certainly was more recent would have been the dot-com bubble back in the late 90s into early 2000s. I'm sure a lot of folks listening remember that, where we had a lot of companies had no revenues or very few revenues, and yet the stock prices were going straight up, and then finally the party ended, and many of those companies ended up going bankrupt.
Yeah, that was the technology sector, the NASDAQ 100, was it?
Yeah, I know the NASDAQ went from, I want to say 2,700 in October of 1999 to about 5,200 in March. So, I mean, that last push up in 6 months was almost a doubling of the NASDAQ index.
And when it finally broke, it went down like 80%, if I recall.
Mm-hmm.
Is that right?
Yeah.
Yep.
So here we have the famous 87 crash. Again, something of a parabolic embedded here preceding the major crash and a high-level consolidation. Another vertical advance and consolidation, finally going to the all-time high, and then ultimately crash. One of the things that doesn't show us well on this chart, but on the daily chart, it's really, really cool. But we have virtually identical formations here. You've got the high, and then a pullback, and then an attempt, another one, and then another pullback, and then it finally breaks and goes higher. And then you have the same one, pullback, an advance, and another pullback, and it finally breaks out, and you think it's going somewhere, and it doesn't, of course. I'll have to show that chart sometime. It's just when people start saying, "Oh, this looks just like this time." Well, maybe it does. Maybe it does, but it's not necessarily going to be the same outcome. Getting to modern times, we have the latest parabolic, and it's embedded in quite a large formation. So, but it's still a parabolic. It's not as long term, and it doesn't have that kind of projection coming out of it. But still, once the parabolic broke, we've had some horrible market action since that time, and we're still good. Cyclical bull market is still in effect, and I still think, based on this breakdown and the kind of market action we've had, I believe we've moved into a bear market. Still more to see before that's for certain, but that's my current evaluations of the situation. I want to look at this at a longer term. Now, here we see the secular bull market beginning in 2009, and then we have the cyclical bull that's going off at a much higher angle of ascent. So this is not a parabolic, but you have the same kind of mechanics. It's getting steeper and steeper. And notice here, the market prices got pretty far away from this rising trend line. And now here we've got, it's much, much farther away from the secular rising trend line. So I'm looking for some kind of correction back to this area. I mean, that's a logical expectation, I think. Let's see here. Okay, what we got? Here's our earnings segment. Now, I saw this kind of a chart many years ago, so this is not an original idea, but I don't see it anywhere anymore. We still carry it on stock charts. We have, instead of showing the actual earnings, you show where the S&P would be if it had a PE of 20, which is overvalued, and that's the red line. And then if it was fair value, is the blue line, and then undervalued is the green line. And you watch price move within that range, and right now, well, here back in this is the 2000 top, it was way above this range, and here we are again in that same kind of situation. You can't do any timing on it. It's just, this is a warning. It's just that this is quite warped, and something could happen at any time. Looking at well, you'll notice that actually, in terms of where the price has been moving, it hasn't been any lower than fair value, the blue line, for 30 years. So why are we concerned about it? Well, looking at the longer term, this takes a while, this chart to generate, because there's so much history on it. But you can see that this was about 90 years. For much of that time, price moved up and down within that range, and it occasionally got way undervalued. And of course, here's World War II. This is right after Pearl Harbor when it got. I'm sorry, here we go. And then post-war, but it stayed undervalued for a very long time, and it gets up to the top of that range and then moves down. This is another long period of undervalue. And then 1984 was the last time we touched that line. It's been Buster's gang ever since. As far as where we're likely to go, if there's, not likely, let's just say that it's not outside the range of possibility for prices to get back down to the green line. Now, when that happens, we don't know exactly where the green line would be. It might be up here, might be down here. But historically speaking, yeah, it could be moved back down to undervalued, and it would be a good time to pick up some stock, I would say. But the 2009 low, look here, it still wasn't even down to fair value. And so again, when are we ever going to see undervalued again is beyond me. Just as an aside here, this spike down in that range, we had in the fourth quarter of 2008, since everybody was in the toilet, companies just threw everything they could into the loss column. And so they just sort of flushed it out and got it off the books. It was a great time because nobody was going to notice it because things were so horrible. Okay, this is a new segment here. We're going to talk about undervalued stocks. And I was clicking through the Dow 30, and I just noticed that Verizon had a PE of 6.5. And I thought, man, that is really, really undervalued. And a yield right now is 4.90, 4.9%, I should say. And I was saying, well, that's pretty good. I wonder if there's, how is AT&T doing? And I looked at that, and here it is. It's got a 5.5% yield, and it's way undervalued again at 7.42. And this brings me to the new feature that Stock Charts has. Oh, I'm sorry. Right here, I did want to see, well, how's the telecom sector doing in general? Well, yield is not anywhere like what those two stocks have. So telecom is not necessarily the reason those stocks are where they are. Here's the cool feature. If you want to look at the dividend history, just go to, it's an overlay, and you select events. And that's what you get. Quarterly dividends. And you can see the history and the steadily rising dividends on that stock. Got the same thing on AT&T. Another thing I picked up, totally off the subject, but you notice, the market hit its bear market low in 2009. These two stocks hit their bear market low in 2008. So there's a positive divergence of price against the broad market. That's a good sign. So that's wraps up my presentation.
Well, we do have just a few questions here.
Okay.
One of the first ones, and I told everybody I put that PE chart in the blog today because everybody wants to know, what the settings are. How do you get that chart? And do we still manually input those numbers into that, or does Stock Charts do that?
Yes, I do. No, I do that.
Okay.
I do maintain that manually. I'm going to try to get Chip's gang to pick it up, but right now I'm doing it.
Well, we'll bug them some more. So anyway, I will put that chart in there so that you can, everybody can go in there, and then you'll have it. You can put it in your chart lists, and so if you're interested in that, that would be great.
This is the great thing about charts, is they give data context. They say, well, the PE is such and such. Well, what does that mean on a historical basis? And that chart just says it all. I mean, it's right there. You know that it's at a, it's really, really overvalued right now. Again, this doesn't mean there's going to be a correction immediately. You can't use timing, but you can say, all right, if I'm making decisions right now, I think, we're in a bear market. Not many people agree with me, but I notice there are more people coming around to that point of view. But you take the fact that maybe we're in a bear market now, and then the market's super overvalued, and you say, well, maybe I don't want to be picking up longs right now. That doesn't mean you want to go short, but right now is the time to, keep your head down. We got, I don't have the daily chart of the S&P 500, but right now it's the 20 EMAs below the 50, which has us in a neutral stance, which is perfectly correct as far as I'm concerned right now. And that's one of the things, getting back to parabolics. Parabolics break all your tools. The so violent upswing that, like for the trend model that we follow, it just gets those EMAs stretched so far apart, it takes forever for them to finally, start doing what they're supposed to do. And the market comes down way too fast for that to catch up, in the beginning. So when that happens, you just have to be ready to, switch to some other tool or method of getting out of the way. And, as I said, I saw when it broke the parabolic and we had such violent market activity, even John Bogle of Vanguard said he's never seen anything like it, and he's a lot older than me.
All right, let's see. Somebody mentioned, since you're talking about parabolics, if you wouldn't mind looking at a particular chart for us. And it was, let me find it now. I had to refresh my chat box here, but I believe it was one of the weed ones. It was hmmj.to.
Okay, so, I'm trying to figure out how to get a chart.
Oh, just go to the enter symbol up at the top there, the sharp chart a little bit. No, yeah, there too. hmmj.to. They're saying that they're seeing a parabolic there. And what are your thoughts?
Absolutely. No question. What is this? It looks a lot like Bitcoin, doesn't it?
Yes, very much.
Yeah, but that's obviously that's one that has a lot of people have a lot of love for, and they get excited about how rich everybody's going to get now that it's legal. But there's a parabolic, and the chances are very high that it's going to go back down to this level. I mean, when you see it doing this much damage, going back to the basing pattern. This doesn't have a very much history, but boy, it's certainly a great example.
Yes. Let's see, what else do we have here? Someone noticed that you use log charts sometimes, but not all the time. Do you have a preference?
I don't. Yeah, my preference is I don't like log charts. The only time I use log charts is when I just have so much history, it would be meaningless for the chart not to be a log chart. Let's looking at this long-term. Now, if I change this to where is that? I change it to linear. All that history from 26 till about the early 80s is useless. You can't see anything. Um, but if you take the gold, I meant to do this too. If you take the gold chart, this is a linear chart. If you, where's log scale? Make it log scale. It takes all the excitement out of the chart. Up and it just, now someone would say, well, that's the beauty of it. But I can never figure out what I'm looking at with a log chart. That's all. And so I don't like to use them, but that doesn't say anything bad about people who do like them, but I don't like them. I don't know what I'm looking at most of the time.
Right. And let's see. Somebody was asking, has Carl replaced PE with forward PE in your chart? And I know we had this question before when we were at decision point. I don't know if I'm asking it. But...
No, I don't use forward PE. I use 12-month trailing, which is the standard, generally accepted accounting procedure. Mm-hmm. And I wouldn't know how to make a chart like that because there's really not the kind of data around. Mm-hmm. So the one thing that would be good on the PE chart, if I could move these three bands back 1 quarter, because basically we're looking at the most recent reading on here is from fourth quarter 2017, and we won't have the first quarter of this year until 30 days, 3 months from now, roughly 3 months.
All right. I think that really, there's a couple of extra questions in there, but I know we're kind of running low on time. What's your thoughts on gold right now? And I know you write every Friday in the Decision Point blog, the weekly wrap. And so if you are curious how Carl feels about the market in general, and, I always do the big four for everybody, highly recommend you go read that because you've been talking about a possible bear market and now the thought that we are in one in the weekly wrap for quite some time.
Right. I was no precise timing on that. It was just I didn't pick a top by any means. It's just a matter of once I saw that parabolic break and then the prices just chopping around in these wild swings. I just thought, no, it's over. But as for gold, my outlook on gold is sort of positive because the PMO is not exciting, but it is rising and it is above its signal line. We've got the 6 EMA above the 10 TMA, which is what I use on the monthly chart. So the price is rising enough to keep those EMAs positive. But the main thing I'm looking for is for this top to be exceeded. I want to see a nice move in it. Then we would have a bottom above a bottom and a top above the top, which sets up your rising trend on a long-term basis.
All right.
You don't have an upside projection. Just have no idea.
Well, as we all know, typically if the market's going to go into kind of a nosedive or continue to trickle lower, typically we see gold do better. It's been sort of chopping around like the market though lately.
It's not a correlation really. I can remember one time the Gulf War when it started, stocks crashed and gold went crazy. But so you would say, a flight to safety into gold, but that was really, I just don't see the correlation. It doesn't. On the TV the other day, it was like gold was up, so that people were moving out of stocks and into gold. That's just nonsense.
Yeah. All right. Well, it's been absolutely a pleasure to have you here. Now everybody can see what my dad and I talk about all the time. Not really.
I have one more question for you, if you don't mind.
Sure.
Yeah, I know that you were talking about, being in a bear market, and everybody's got their own opinion. And, definitely we're consolidating, trying to figure out markets, trying to figure out which way it wants to go. What would need to happen for you to feel like, well, that bear market call was really maybe, you were looking for something to confirm it, you never got it, and now you're back in the bullish camp? What would need to happen for you to become more bullish about the market?
Well, to become more bullish, let me see if I can. This chart is not scaled for this presentation, but I think it'll do. Right now, the 20 is below the 50. That needs to be reversed. And well, beyond that, new highs be made. I don't think that's going to happen. What I think might happen is that if you look at that, I think we're going to see that declining tops line exceeded. That's possible. And but I don't think we're going to see new highs. That's just the way I see it right now. But
so you would remain cautious unless we broke out to new highs.
I'm sorry, say again?
You would remain cautious unless we broke out to new highs. That's what you would look for to confirm the continuation of a bull market, would be the SPY breaking out to a new high?
Yeah, that would, certainly, make a big difference. But, getting the 20 back above the 50 EMA, that would put us on a buy signal again. It's just that for one thing, I feel it's very risky at this point in time. I considering how overvalued the market is and the way the price action has been, it's just risky. For me, trying to, at my age, I don't have time to make it back. But it's.
Well, I know a lot. It's funny because we did get a comment. Oh gosh, Tom, you remember it a while back, saying something like, we were young whippersnappers, that we needed to talk to Carl, somebody who had lived through some of the bear markets, so that we would see reason that this is actually could be a bear market, because they just thought we didn't have the experience, Tom, right?
Well, I tell you, I've experienced it because I've got a portfolio to show going back through a couple bear markets. So, I've got the experience there. But I guess for me, because I'm still residing in the bullish camp, and the big reason, and I'll talk about this a little bit more when we get into sector rotation later in the show, when you look back at the last couple of bear markets, money tends to rotate into very defensive areas at the last high. You start seeing deterioration in a lot of the relative strength in key areas like technology and financials and consumer discretionary. And my biggest problem is that we really haven't seen that deterioration. And so underneath the surface of what's going on, yes, there's a lot of volatility. Yes, there's a lot of back and forth action. It's scary, but I'm still seeing pillars of strength underneath the market, even though those swings have been very, significant. So that's kind of what I'm banking on, is I just haven't seen the market. And to me, it makes sense. If we're going into a bear market, there would be a lot of money being repositioned into more defensive areas. And that's just doesn't seem to be happening yet.
Well, the thing is that if you look back the last 20, 30 years, that there's not been any parabolic tops either. This is the first one of those to come along for the S&P for a long time. That's why I think it's different this time, But I know what you're talking about. Normally the market rolls over. The tops are kind of gentle and et cetera. But this is just that parabolic break to me was a really major sign, But again, it's a matter of how much do you really need to be in the market? How much exposure do you really want and need? I mean, it's really a personal it's a personal decision, and you have to take what you know and um, go with that. Make your best decision.
Yeah, I think it gets back to managing risk, and of course that's what everyone's going to be talking about at ChartCon, because it is a personal decision. I mean, I can sit here and say it's going to, I'm bullish, and you can say you're bearish, but really it's everyone else out there has got to figure out what they want to do with their money and live with the consequences. So it is a difficult decision to make, and those who are cautious probably should hedge or have some kind of protection, one way or the other.
Back when I was starting out, one of the kind of the template for doing this kind of work was to come up with an outcome that you thought was going to happen, and you would stick to that. You would pound your fist, and that was it. This is, it's kind of like the Joe Granville model, and that's the kind of thing that I saw for many years, and tried to emulate, and found out that I didn't sleep well because a lot of times I didn't have the courage of my convictions, but I just think it's so much better that we can have a discussion about this, and
yeah,
and
right, we can all have different opinions, and
right.
Yeah. It's a little bit more, yeah, you've been in the market timing arena. And so a lot of, let's face it, Timer Digest and such. I mean, we have to say, hey, it's going to go up next week. Hey, it's going to, I think the Dow's going to end at this. So, I mean, we do as market timers, I think sometimes have to, take draw a line in the sand. But ultimately with the analysis, we can temper that as well.
Right, well, years ago, I switched to using the trend model, because that was my official position. I mean, I could have an opinion different from what the model said, but that was the official position, and I didn't have to lose sleep about whether I should change it the next day.
Mm-hmm.
Definitely is an advantage of a mechanical system, is that you just follow your signals. Boom, it's done.
And it's not the greatest system ever, but it just gives you the 50 is 20 is below the 50. Well, that's a weak market. That's it. Period. It takes a lot of, and then get the 50 below the 200. Well, that's a bear market, and that it takes a lot of work to get that kind of a relationship. And so it tells you, it gives you a context again, or this is a broad brush of where the technicals say the market is. But it's not perfect.
I do want to say that, just like last time, it's a pleasure having you on the show. We're constantly getting that decision point flavor from Erin, who continues to carry that torch for you here on the show. And it's a different perspective, but it's one that makes sense, because like you say, when the moving averages, you can't have a bear market without those moving averages flipping. So once you see that flip, you definitely need to take necessary precautions. And we're seeing some of that in the current market for sure.
Yes. Well, thanks so much for coming on. And hopefully, I managed to get you on, and it wasn't my birthday. Hopefully we can get you back in the next month or two. That would be great.
Yeah, that'll be great.
Hey, Carl.
Wait. Yeah.
My birthday's next month. We will have you in for my birthday.
Okay.
There you go. We'll have Zach set it up.
Have a good one. It was good talking to you, Carl.
Thank you. Bye.
All right, there he goes.
Excellent.
Yep, I know we've got a bunch. I tell you, I'm going to be under pressure. I know you're going to put me under pressure, and I'm ready to go. So if you want to just jump into it, let's just do this.
Yeah, let's just do it. I don't need to go show we had like 40 requests, so it'll be interesting to see what comes out of this. But first one, GEO.
Okay, this is going to be a record. I promise. It's going to be a record going through here. GEO, first of all, it's downtrending. So, overall in the market, it's clearly a laggard. I'm not very interested in it. It's struggling here sideways. It looks like 21.5 to 22.5 is kind of an area where we've seen some support and resistance over the last few months. I'm not a fan. Things are picking up, But until we really break this downtrend, I'd be careful here.
All right. Next one will be Sears Holdings, SHLD.
Starting to see some strength. There is one key area of resistance. It's in a strong group, which I like, but we're starting to see some of these beaten down companies in this space start to rebound. Look at the volume today on Sears as it's taking out what I think is probably the biggest area of resistance on the chart. You can see we already tried this a couple weeks ago, getting up through about 310. We failed. Now we're making another move. The 20s crossed above the 50. I see a lot of positives here. PPO strengthening. I think this is a nice looking chart. One thing I'd be concerned about is if we fail today and go back down and close below the 310 level and leave this long tail up here, we may have one more trip down to the 20. But other than that, I think this one looks really nice.
All right. Let's see. What was our most popular request? Looks like let's try VRX. There was a kind of a tie right there, but we'll do VRX. And then since it was a tie, I'll do this. The next one is the other one.
All right. VRX has been under a lot of pressure, as you can see, and the volume was pretty significant as well. As you can see, this drop right here on very heavy volume. It took out the low, which was at about 17, and did it on the heavy volume, and notice the failure was at 17. So right now, I would just trade VRX as though it is in a pretty narrow range for this stock, pretty narrow. Between 15 or just below 15 and up around 17. And if we can get through 17 and get volume to confirm that, then we could resume that prior uptrend that we saw back at the end of 2017. Otherwise, I'd be careful here as we get close to resistance at 17.
All right. The next one, and we know what a fan you are not generally of this one, but GDX, gold miners.
Yeah, I'm not a fan, and mostly just because the dollar since 2011 has been in an uptrend, but the dollar's at a really interesting area. And if the dollar were to break down, if the dollar index breaks down below 88, I mean, I'm not going to ignore that. That would be a positive for gold and for many of the commodities. I just want to see that breakdown first. I think the dollar is at a key pivotal area where I expect it to go higher based on a number of factors, especially interest rates here in the U.S. and how quickly they've risen relative to other areas like Germany. But I think that GDX, first of all, it's having a great day today, as you can see. I do think that there is some overhead resistance. We've struggled on different occasions at about this 23 level. You can see it held as support back in early 2018. It's failed as resistance a couple of other times, and that's right where we went today before we started to turn back down. I see improvement, but I'm not convinced that this is going to last longer term.
All right. Next one, Mercury. And let's see, Mercury General, MCY.
All right, MCY. Not a fan. Yeah, we got some recent strength, but until we can negotiate gap resistance, there was a huge gap down on very, very heavy volume right here. The volume had picked up over 1 million shares. That was a huge red candle. We came all the way up, and we've talked about this many times. When you get that tail above a key area of resistance and it fails, you want to be real careful. You can see what happened with MCY after that failure. We're making another move back up. I think you've got room maybe for another 2 or 3% till you hit that level, but I want to see volume come in and confirm a breakout before I'd get more bullish.
All right. Next one, Kemet, KEM. Electrical components.
KEM. All right. Yeah, another one with a huge gap down. It's kind of in this gap. I'm going to go back just a little bit further here. Let's go 10 months instead of 6. I just want to see more history here. Yeah, the price breakdown and gap resistance up closer to 24. And I think, again, you can look at this stock and you can see that just on a relative basis, this is a stock that has not done very well relative to the S&P 500. And again, for those of you not familiar with the show and with my strategy, I'm trying to outperform the S&P 500. That's my goal every year. And so I want to find stocks that are outperforming the S&P 500 and trade those. This has been going sideways, obviously had a big down move on very heavy volume, almost no volume right now as it's trying to come back up here. There's nothing here that really sticks out to me. I think it's got major upside overhead in the months to come between 20 and 24, probably even 20 and 21. which is this reaction high. So I'm not interested in this stock.
All right. The only consumer staples request, Pilgrim's Pride, PPC.
All right, PPC, positive divergence. I'll give it that. Still got a little ways to go before it hits key support level. You can see that bottom back in, I guess that would have been back in July of 2017. So we got more room to get down to there, but I do like the fact that as we continue to move lower, right in here, all of these lows are being accompanied by higher PPOs. So that is a nice positive divergence. But recently we did get up close to the 50-day moving average. You can see that the PPO has worked its way back close to centerline resistance. So maybe we have a little bit of upside momentum or an upside push coming in PPC. But I think it would really take a breakout. I'm going to say above 26 before I would be thinking that this downtrend that started back in December is over. This has been a pretty big drop from, this is not your normal pullback, $38 down to 23 in 4 months. That's a pretty significant sell-off. So I'd have to get a little bit better feel technically for a breakout, maybe above 26 with some heavy volume before I'd actually look at this as maybe an uptrending stock.
All right. Let's see the next one, DAX ETF, DAX. Germany.
All right. Well, I do like the fact that the bottoms were holding, and you can see this is where we broke out from, right around 29.5. So I think that it's held the key level. Now, it has not been a very good performer. I think that's pretty obvious. But here was the sideways consolidation, the breakout. We came all the way back, and with all that selling early in February, we nearly tested it. We've gone back down twice, actually 3 times, and hit this level, and now we're starting to move back to the upside. And all of this came, by the way, with lower closes and a higher PPO. So we've reset the PPO. We're back at the 50-day, close to the 50-day. I think it depends where we go from here. I think the slate, is pretty much clean now on the DAX. And when I say that, I just mean from a momentum perspective. I think we've done what we needed to do to rectify the slowing momentum issue. But I think the market is still bullish. I think that Germany, we're going to go higher. I think here in the U.S., we're going to go higher. And so I'm sticking to my guns until I see something that tells me otherwise. So I think it's going to go higher. But for now, we are sitting on that 50-day. Let's see where we break from here.
All right. For our Canadian friends, and I know Carl looked at it a little bit, but for you, we.to.
Okay. I always want to say I don't think it can go any higher, but no, never mind. Okay, let's see here. Well, we broke out right at about the 21 or 20.5 level. We went all the way back down, tested that. So clearly, the line has been drawn. I think, and an uptrend is simply a series of higher highs and higher lows. Here was the move up to set the higher high. Here is the move down to set the higher low. And we're trading in a pretty wide range. I think that you can make an argument that you've got some support here around 25. So for those interested in accumulating, I think 25 down to about 21 would work. This is a volatile stock. It's very difficult to keep, a really tight stop on a volatile stock, or you just get yourself whipsawed. But I think 25 down to about 21 is where I would accumulate if I was interested. A close below 20 would really be a damaging development here on the chart. To the upside, I could be a seller at 35, see if we can get through there. We had a double top there. So there are some trading opportunities, but I would be careful because it is volatile.
Absolutely. All right, final one, and you did very well. ETFC.
E-Trade.
Yes.
I like the financials, and I think we got a nice little cup that's been working here. So I'm I'm feeling pretty good about this. Nice uptrend, followed by, let me mark this. But right here and there, by the way, is another false breakout. You got to pay attention to these. You had a high at 58. You can see that intraday move actually cleared it, came back down. We failed to hold it. And then 2 days later, we were down about 8% on ETFC. But we definitely have a top up around 58. And since this high, What I'm looking at is what looks like at least the start of a cup off of an uptrend. So I think it's still in a bullish pattern. You can see the PPO has been above the zero line much of the past 8-10 months. And so I think this is a nice trending stock, a stock that's outperforming the S&P 500 because it is on the verge of breaking out. And so I like it. I think a pullback maybe even to the rising 20-day would be a nice entry on ETFC.
All right, excellent. And that completes the 10 and 10. Very nice. We did that very quickly.
I tried.
Yeah, you did great. All right, so let's see. And with that, those are our symbols that you can see. It looks like the screen's a little bit odd right now, though, Zach. I don't know. Maybe it's just me.
Yeah, it seems fine on my end.
Okay, then it's just me. Not sure what happened there. But anyway, let's see. So that concludes that. Let's go ahead and get into, well, let's talk very briefly about ChartCon, and then we'll get to, let's see. I know what I did wrong. Hopefully it didn't mess up anything else. Okay, so reducing risk, like we were talking about, Tom, should be really good. August 10th through 11th. It is an online conference, so you don't actually have to fly to Seattle to go. If you want, there still are, I think there's still a few VIP positions left if you do want to come and join us. But right now, you probably want to go ahead and get in here and register because we are doing early bird pricing right now at $199. This will give you all of the conference speakers, all of the presentations. You've probably seen some sample ones from our 2016 ChartCon, and you'll get to keep all of that yourself. And don't count on this stuff being on Stock Charts TV. If it is, it won't be for probably another year and a half. And I don't know if we'll do it then because we'll probably have so much programming to fill. So you really do want to go ahead and go and join us online. It's a lot of fun, even if you're just sitting at your chair at home. We do a lot of social interaction, social apps, that sort of thing. So a lot of fun. All right, with that, let's go ahead and look at the market. What's going on? And I don't think I need to refresh this. I just put this up a little bit ago. All right, so as you can see, kind of choppy trading today. I mean, the Dow's been in negative territory pretty much all day, forming somewhat of a double top here. And at this point, it looks like we're just going to chop around sideways, which is sort of what I've been looking for a while here, as far as, versus bear market, more consolidation sideways. So we're seeing that still. It's still a volatile market out there, Tom. I mean, it just is. We can see that the S&P 500 is lower on the day. NASDAQ, however, is staying in positive territory since just before lunch. Small caps doing fairly well. They've been in the positive territory pretty much all day, with just a little bit of a downtime earlier on the day with the other markets when they opened lower. But since then, it's been trailing higher, looking pretty good. The Canadian markets, TSX, had a great morning, unlike us, and then has pulled back likely in response to a lot of the large cap indexes right now in the US. Treasury yields are mostly unchanged at this point. We could see that TLT, we've got a gap up and it hit an intraday high and has now been falling since about 11 Eastern. UUP gap down on the open, found support right around 2340 and is heading back up again. Currently reading 2347, down only 4 cents right now for UUP. Commodities are higher, but pulling back. USO is obviously affecting the commodities, DBC. And we can see a nice move up, but has hit an intraday high and is consolidating now sideways. We can see gold gap up, had a nice push during lunchtime, but it is pulling back, but still up, 128.54 for GLD. And finally, as Tom noted, the VIX has been slowly coming down, really since midday yesterday. Now we're getting readings right about at 20, currently reading 20.08. And with that, I'm going to conclude our market update. Did you have any charts you wanted to show, or should we get into that sector rotation?
I'll just take the screen just for a second. I want to point out a couple things. With the Russell 2000's outperformance today, you can see this is a chart of the Russell 2000 relative to the S&P 500. And since we put in this double bottom at the end of January and again at the end of February, we have been seeing fairly consistent outperformance by small cap stocks. And what's interesting here is I really thought it would coincide with a rising dollar. The dollar so far has been relatively weak, though. I mean, today is another down day. The UUP, which is kind of the proxy for the dollar index. Here it's been coming down. It's down for the fourth day in a row. It is off of its lows from earlier today. But the fact that we're breaking out on the Russell 2000 to a new recent relative high maybe is a bit surprising, but it could be that the market still is anticipating, like you and I've been talking, that the dollar is going to rise. And that may be part of the reason why we're seeing that outperformance. The other thing I want to just mention quickly, and then I'll let you take it back, Erin, is the S&P 500. This is the fifth day in a row that we have either moved through the 20-day moving average or we have tested it without one success yet getting through. And you can see the last big sell-off occurred after we had a failed breakout above the 20-day moving average. And I'm not trying to predict that we're going to go lower. Historically, actually, it would make sense to see a continuing rally. But technically, I think that this is important to try to get through. We are seeing a much stronger PPO starting to turn back higher. So if we could get a breakout in price above the 20-day moving average, I think the bulls would have a lot of momentum back on their side. But that still remains to be seen. We need a strong finish in the afternoon. Almost did it yesterday. I think we closed less than 1 point above the 20-day, which to me is really not a breakout. Today we were above again. So let's see if we can get a strong finish today.
All right. With that, let's go ahead and we're going to move into sector rotation. Go ahead and grab my screen here. I'm going to talk about that in just a moment. All right. So if you go to Chart School under Market Analysis, you can go to sector rotation analysis. And that's pretty much what we look at in this particular segment. And so if you go in here, we have quite a few charts to explain what sector rotation is and what you're looking for. But I have this one graphic and I'm going to go show it to you. And actually, I'm going to try and share this so it'll be a little bigger for us. Yeah, didn't help much. I'll make it a little bigger, and I know that our producer can move on. I need Denvy to make me a pretty one. This is just one I obviously stole off the internet. But what I'm showing is the different sectors and where they are. You've got your defensive sectors, of course, the consumer staples, healthcare, utilities. This tells you what's going on in the economy, really. Are you expanding? Are you contracting? So that's why we look at which sectors are more healthy versus those that are not as healthy, because that tells us we're either moving up and expanding further, or we're topping, or we could be bottoming. It just depends on which sectors generally are doing well at the time. And so that's what I've been watching. That's what I've been writing a lot about. It's not really my specialty, but it's just something that's really been, just bothering me in the background. It's just that one thing that's just niggling at you. It's just, I can't figure it out. But I've been watching this very closely because of that. It worries me. And I'll show you some of the issues I'm having. And while I'm not subscribing to Carl's thought that we are in a bear market right now, but I think there are a lot of signs that are telling me that, obviously in this volatile market that we've been in, you can see that those defensive sectors have done fairly well during this volatile period. And I'll explain that a little bit more, show you just a little bit. We're already a little low on time. But as you can see, this is the market cycle is in red here. And so when you're at a market bottom and you're in the midst of going into this bull market, these are typically where you're going to see the technology and cyclicals doing well. And now what we're watching is, of course, energy is now starting to take off. And that bothers me. Consumer staple. Yes.
I'm not seeing anything. I'm still looking at that.
Yes, thank you. Okay, let me move that very quickly. Okay, I need a new share. That's the problem. I tried to share just part of my desktop here. All right. So yes, so technology, financials, that's when you're going to see this is the red line for the market. That's what you're looking for during the bull market. You're going to see these doing much better. Right now, we're starting to see energy and staples get more healthy. I think that, Greg said we're looking for a 3-month move into these areas before we really should be looking at a bear market. But I'm seeing in this choppy market right now that energy and staples are really doing much better. So I've got we've got the intraday sector summary, so you can see which ones are doing well right now. Always interesting when you see the cyclicals and the consumer staples doing well at the same time. But what I've been doing is going back 1 week and seeing which ones are leading, and then 1 month, which has been what's bothering me. Is in the last month, energy and utilities have been the big movers. Consumer staples, while leading above cyclicals, barely, and it's only a matter of not losing quite as much as some of the other sectors. So I'm going to go back 3 weeks and we'll look at this. And there you go. So in the last 3 months, I'm sorry, everybody's been down. So it's just really a matter of who's suffered the most. And at this point, we're not seeing, like I said, on a 3-month basis. That's what Greg is talking about. We're not seeing that deterioration just yet from the cyclicals and technology overall. I mean, it's been bad, but it's gotten better. Let's put it that way. And that's brought technology sort of back up into, the lead. But in the past month, we're seeing these three up at the top, and that is bothersome. But it could also just be a characteristic of, a bear market sort of configuration right now. The bears kind of being in charge right now. It could just be a characteristic of that. All right.
Okay.
I'm going to hand it back to you. That was sort of what I wanted to talk about. I'm just concerned about this, but as I thought about it too, not to bolster a bullish position, but we have been in a choppy, uncertain market, very volatile, as we've been talking about. So, it makes sense that maybe we're seeing people move into those defensive sectors just during this period of volatility. It may not mean they're going to park there. If they park there, then we probably should get really worried.
Yeah, what I wanted to show on this is just this is a chart back in 2007. So this was the S&P 500 in the latter stage of 2006. And then you can see these pullbacks in 2007, but we did manage to move to new highs. If you look at the volatility index on these pullbacks, the first pullback here, you can see first the VIX. As we started 2007, the VIX was at 10 or 11. So the market was very complacent, wasn't thinking bear market. And so the first spike in the VIX occurred back in February, March 2007 on the first bit of selling. And this could be similar to what we just saw. Who knows? Well, time will tell. Then we rallied back up and had our second bout of selling. And you can see the volatility index really soared here. And during our final move up in October of 2007, which marked the top of the bull market, it coincided with the VIX moving back down to about 16, 17. So even as we were breaking out to new highs, normally, when we're moving up, the VIX is going down. But here, as we kept moving to these new highs, the VIX actually was rising steadily. And this is one of the components or one of the ingredients of a bear market. You need to have high volatility. The market has to be expecting volatility. It has to be fearful. It has to panic on the selling, at least the initial selling. And that's what we saw in 2007. We're seeing a little bit of that right now, no doubt about it. So the volatility index should worry you. It worries me. But as we start looking at other areas of the market, here's the XLY, XLP. We topped in early 2007. And even as the market kept continually moving higher, money was rotating toward the defensive areas. And think back to that chart that Erin showed, where money at the end, or as we go into a recessionary period, money begins rotating into healthcare, staples, consumer staples, and utilities. This is the visual of that actually happening in 2007 as money rotated away from the aggressive consumer discretionary and into staples as the market was making its all-time high at that point. And you can go down through the other. Transportation utility also had topped. This ratio had topped and we rolled over. Go down to the Russell 2000 versus the S&P 500. That had topped early in 2007, was rolling over, and the banks relative to the REITs not only broke down in latter part of 2007, but completely fell apart in 2008. As we know, we had that financial disaster. The next chart I wanted to show you here, and I'll try to go through these pretty quickly. I know we're running out of time. The S&P 500, again, this is 2007. You can see that technology, as we went into the bear market, began to underperform. And you can see the XLY was underperforming in 2007 before. The XLI did not confirm a relative breakout as the S&P made that new high. Neither did the financials. The XLF was not breaking out. In the meantime, you look at the defensive areas, healthcare, utilities, and consumer staples, and they all actually had higher lows, even though the S&P was at an all-time high. And then check out what happened throughout the balance of the year. We started really rotating. Even in here, as we go into December, we made a move back up. We weren't far from the all-time high, but look at the deterioration in the aggressive groups relative to the S&P, and look at how the money had rotated into the defensive areas. When I look at where we are now, and I'm not sure let me see which one of these charts it is. Let's go ahead and look at this one. This is 2017 into 2018. Now, here's that first spike in the VIX. So this could be something that's long-lasting. I don't know. Time will tell. But look at the XLY versus the XLP. We were breaking out. Even as the S&P 500 was moving down, we were breaking out. Now, we have seen some profit taking, no doubt. And this is what Erin was just talking about in the last month. We have seen money rotating, but the market itself has been pretty weak. And that's kind of normal when the market's weak. What would concern me is if this keeps going down as the S&P makes another high. That would be very bothersome to me. Transports, utilities also pulling back, but we do need to see whether we can recover on this. Russell 2000 strengthening. Banks have been pulling back, but still are in a nice uptrend. So, I mean, we could go on and on, but that, to me, the market is different now than it was back then. So with that, let's go ahead and wrap up the show, talk about what's coming up.
Indeed. It's been a great show. I love talking to my dad, obviously, for various reasons, but talking the stock market with him, that was absolutely great. So right now, there's our sector rotation, what I covered and what Tom looked at. People were wondering about those slides, those graphics. I will have the graphics and a link if there are links to those graphics, but in any case, they'll be there for you. On Friday, I will be doing my workshop on divergences and confirmations. So you'll want to come in for that one. I'm in the process of preparing it right now. Should be fun. And that pretty much is it for us, Tom. It's been, like I said, a pleasure talking to my dad, hanging out with you as always.
In 30 seconds or less, what was our poll results on Netflix?
Oh, good question. Our poll results were yes, 50% think that Netflix will beat estimates and move to new all-time highs after the Monday earnings announcement. 27% said maybe, and 22% said no. So which camp were you in?
I would be in the maybe. I mean, I'm not going to, like I said, I own Netflix right now, but I'll be getting out before Monday, no doubt about it.
Okay. I said yes. I think it's going to do very well. But
well, it's in a strong area of the market, and it is one of the leaders in the specialty retailers, no doubt about.
Mm-hmm.
All right. Well, that brings us to the end of another great show. I want to thank Carl for joining us today. Look forward to seeing him again soon. I want to thank all of you for being with us today. Please remember to complete that survey as you exit. We do love to get your feedback, to hear what you think of Market Watchers Live. A quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody, and we'll see you back here on Wednesday. Or actually, today is Wednesday, isn't it?
Yes.
All right, never mind. Have a great Wednesday afternoon, everybody. We'll see you on Thursday. Happy trading.